So most homeowners know how a HELOC or a home equity loan works. You're essentially borrowing money and you're paying it back with interest. A home equity investment with Point works much differently. You get cash up front with no monthly payments, and in exchange, they take a share of your home's future appreciation. Based on the questions I get from readers talking about these sort of things, it's really not. Under the hood, most home equity agreements in general, including Points, do confuse some people. So in this video, I wanted to break down exactly how Point works, what to expect during underwriting, what to look for in the fine print, and how what's known as a risk-adjusted calculation is going to affect how much you ultimately owe. I'm R.J. Weiss. I'm a certified financial planner and founder of the Ways to Wealth. I've now analyzed the home equity agreements from all the major companies in the space, and I've really seen firsthand how the fine print can really change the math at the end of the game. So for a deeper dive into how Point works, as well as the full breakdown of its pros and cons, I've linked to detailed resources below. You can check them out if you want more takeaways. So home equity agreements are not standardized such as traditional loan products, such as a HELOC or home equity loan. Each company uses its own formula to determine what you'll ultimately owe. And the underwriting process from one company to the next can really change. So before we get into all this fine print, let's go on a basic level and understand how Point's home equity investment truly works. So here's the core idea. With Point, you're not getting a traditional loan. They're making an investment in your home. In return for giving you cash up front, they get a share of your home's future appreciation. So what that means is when you go to refinance, when you go to sell the home, when you want to buy out Point from the contract, they take a percentage of how much your home has gone up since the agreement began. So if your home rises significantly, they benefit right alongside you. But if your home stays flat or even goes down, Point will not get as much.
Could you end up repaying less than you receive from a home equity agreement? It's possible, but it's rare.
So that's because these agreements are not necessarily like a straightforward trade. You're not, say, giving up 10% of your home's value today in exchange for, say, 10% of your home's value at a future date.
Each contract has its own terms, and the way costs are calculated can vary significantly depending on how your home's value changes over time.
Unlike a traditional loan where your payment is typically fixed or defined up front, with Point, you really don't know the exact cost into the end. And that makes understanding these details really important up front because small differences here or there can really add up over time. So here's another thing to know about Point structure. They offer a maximum 30-year term. So you can exit the agreement, which essentially means buy out Point. You can do that through refinancing. You can do it with cash or when you go to resell the home at any time during these 30 years, but you have a maximum of 30 years to do so. So you're never locked in here. And this is important to say because some home equity investment providers only offer 10-year terms or shorter than that. Point's 30-year term is actually a benefit here just because it gives you more flexibility and options down the road. Say you want to age in place or don't qualify for a reverse mortgage or aren't looking for that product for several reasons, this agreement with Point can last through retirement with that 30-year buyout. And again, to end the contract, you're repaying in one lump sum. It's not like a traditional loan product where you're paying payments. It's one lump sum, which you're going to get through cash, through savings, through refinancing, or simply when you sell the home, you're going to pay Point off then. So before we get into pricing then and how much this can potentially cost, let's talk about eligibility. You'll start with a 60-second pre-qualification. So it's a soft credit pull here. And really what they're looking for is those major boxes being checked. So for Point, those major boxes are it has to be in the eligible market and your home worth at least $155,000. You need to retain a meaningful portion of home equity after Point's investment, usually around 20 to 25% or more. While Point is more flexible than banks, they do require a minimum credit score of 500. So they don't fund commercial properties, manufactured homes, mobile homes, homes owned by LLCs, or anything with 5 or more acres. And then on the lien position, Point typically needs to be in the third lien position or better. If there are multiple loans ahead of them, you may not qualify. So once you pass pre-qualification, the full underwriting process can begin. And it's here where your final terms start to be determined. And this is based on things like an appraisal of your home, a title review, and other key financial factors. Through this stage, there's no out-of-pocket expenses. While there are closing costs, these are taken out front out of the amount they give you, but that's only if you accept the offer. So now let's get into costs. So Point uses a formula that includes what they call an adjusted home value, sometimes referred to as the appreciation baseline. This plays a major role in how much you ultimately owe. So after you make it through the pre-qualification stage, Point begins by ordering an independent appraisal to determine your home's fair market value. They then apply a risk adjustment, typically between a 20 and 30% reduction, to calculate your adjusted home value. So think of this as the appreciation baseline. So that's the number they use to calculate your future home appreciation. So they're not using the full amount of the home's value. They're using a number above that appreciation baseline. So for example, if your home appraises for $500,000, point applies a 27% risk adjustment, your appreciation baseline becomes $365,000. So Point doesn't take a share of appreciation from the full $500,000, and they only share what your home increases in value above $365,000. So say your home sells for $600,000, the $235,000 of upside, which is $600,000 minus $365,000 is what's shared. So according to your appreciation share percentage. So once your adjusted home value is set, the second number that gets locked in is your appreciation share percentage. That's the percentage of appreciation above your adjusted home value that Point receives when you settle the agreement. So whether that's through selling or refinancing or buying them out with savings. Let's go back to the example. Initially, your home price is for $500,000. Point applies a 27% risk adjustment, bring your adjusted home value, the baseline, to $365,000. Now let's say a few years go by and your home increased in value and sells for $600,000. That's $235,000 in appreciation above the $365,000 baseline. Say now your appreciation share percentage is 25%. Point would receive $235,000 times 25%, which comes out to $58,750. So this is what they receive in addition to repaying the original lump sum they gave you. So in this example, you repay the original amount you received from Point, which is $50,000, plus $58,750 from the appreciation for a total of $108,750. So whether or not that is a good deal depends on many variables. So if you're holding the agreement short term, that's a higher cost of borrowing. If you hold the agreement longer term, that could come under what a HELOC could cost. Obviously, this depends on current rates. So if you're planning to use Point for a short-term project, like a renovation, it's worth knowing about Point's homeowner protection cap. So you'll see this number during your underwriting. If your cap is say 20%, that means that the cost of agreement can't go over 20% per year, even if your home value goes up a lot. So this is why understanding both numbers, the adjusted home value and the appreciation share percentage, is really critical to understanding what the agreement could actually cost you. And what's important to keep in mind here is the better your financial profile is, things like your credit score, your debt to income ratio, and whether you have other liens on the house, the more favorable your terms would be. And for you, what you're really going for here is a low appreciation share, generally means like the better deal. So next, let's dive into some of these examples on Point's website. So first things first, the scenarios I'll share assume a combined loan to value ratio of 49% and a FICO score near 740. In reality, your terms hinge on underwriting. Things like your home's appraised value, property details, and credit history. So Point's online calculator may show these numbers, but if your, say, LTV is closer to 75% or your credit score is in the 500s, the deal could look very different. With that context in mind, let's run through some real examples using Point's calculator on the website. To give you an idea of why these details matter, I ran through several scenarios through Point's own cost estimator. In this example, we start with a home worth of $500,000 and receive $50,000 up front through Point. The estimator assumes your home appreciates at 3.5% annually, which is right around the national average. Let's look at what happens then if you exit the agreement in different years. So
scenario number one, let's say you exit the agreement then in 6 years. Your home is now worth $615,000. Point share would become $101,000 and your share, it comes out to $513,000. That works out to an annualized cost of about 12.5% based on the appreciation you shared. Scenario number two, if you exit the agreement in 8 years, the home would grow to $658,000. Point share would then increase to $110,000, and your share would then be worth $548,000. This works out to be about a 10.4% annual equivalent cost.
Again, your numbers may look wildly different, and if your financial profile isn't as favorable, you should expect them to be. The other thing to point out here is the effective cost can vary wildly based on how long you hold the agreement and how much your home increases in value. So with that out of the way, I hope you start to get the sense that if you can qualify for a HELOC or a home equity loan with monthly repayments and are comfortable managing those may be the lower cost options. Point's home equity investment is really the right fit if traditional options don't work for your current needs. So who might it then help? So say you have equity but have a low credit score. You need a lump sum up front but really can't handle monthly payments on the back end. And you really got a clear, immediate, and high purpose value for the money, like such as avoiding a foreclosure and being able to make your mortgage payments or making those necessary home repairs for you to live in a house. Obviously there's trade-offs then. You have an unpredictable final cost of this. So points repayment is going to depend on how much your home appreciates, something no one can predict. And then you're going to see less favorable terms for higher risk profiles. If a credit score or your combined loan to value ratio isn't as strong, expect a higher appreciation score, and that's going to raise your total net costs. Here are a few circumstances then where points home equity investment might work to your favor. You can't get or don't want traditional financing. You need cash and monthly payments just don't fit into your budget. You have a concrete plan for that money, and you fully understand that you have to share part of your home's appreciation. And that said, much of it is going to come down to your terms after you go through underwriting. If your financial profile can't qualify you for good terms, it may not just be a good fit. One last thing I'll mention is I treat this almost like a reverse mortgage. Reverse mortgages require a HUD-approved counseling session to ensure borrowers understand the implications and alternatives before signing the agreement. I strongly recommend, if you're considering a home equity investment with Point or any other provider, you speak with a fee-only financial advisor or an independent housing counselor before moving forward with the agreement to make sure you truly understand it. Home equity investments like Point can get complex, and having an unbiased professional explain the details to you so you can make the right choice is probably in your best interest here. Your agreement and terms may look entirely different from the examples I provided in this. So it's not much a question of whether home equity agreements are bad or good. It comes down to specific terms that you're offered, and more importantly, how you plan to use the money. So to wrap this up, home equity investments like Point can help, but like any home equity or loan product, they should be used with discipline and a purpose. Anytime when evaluating a product that's secured by your home, only move forward with the plan to use the cash on something that has a high personal return for you. For a more complete analysis, I've created detailed resources on the Weiss to Wealth that include comprehensive comparisons of Point to other home equity providers, plus more on how home equity works and its pros and cons. The links are below, and if you found this breakdown helpful, subscribe for more detailed analysis of financial products in the space. I regularly review options that are more complex and not as very black and white to help people make informed decisions. Thank you.